So you're excited you're going to buy a home. How much money do you need to put down?
There are so many options across the board. I think people generally think they have to have 20% to put down. That's just not true. You can put as little as 3 or 3.5% down on different programs depending on your circumstances, which can help keep money in your pocket for unforeseen circumstances like repairs or furniture or a new roof. It just depends on the home that you're buying, the condition that it's in, and what you might need the money for. The difference is that if you put 20% down, you won't have PMI or private mortgage insurance. And I think that's where the confusion comes in. If you put less down, that's great. You just have a little bit of an increased payment by adding that private mortgage insurance, mortgage for the lender, because you're putting less down as part of your monthly payment.
And if someone is not sure how much they want to put down, if they're thinking 5%, 20%, they're just not sure, one thing that we always want our clients to consider is cash is king. You're buying a home. You don't know if you're going to need to put a new roof on it in the next, year after you buy it. You might need to replace the AC unit. You might need to, buy new appliances. All those things cost money. And also considering the moving expenses. Those are more expensive than a lot of times clients realize. So all of that considered, sometimes it's easier or better to put less money down initially. And then let's say you're in the home, after you're in the home for a year and you've realized, hey, things are in good shape. I don't need to buy a new roof. I don't need new appliances. I've got this extra cash available to me. You can always pay down the principal balance of your loan and then have your mortgage recasted based on that new balance. So what you're going to basically do is have a new lower payment, just like it was if you were to put that money down at closing when you first bought the house.
So nothing about the original loan changes. It just brings the balance down and recalculates your payment based on what you owe now and the interest rate that you locked in when you did the loan originally. So it's a great option. You don't have to refi. You don't have to have the costs associated with refinancing. You just literally put the ball in motion, bring the balance down, re-amortize the payment, and on your way.